debt to equity ratio and its impact on shareholder returns, exploring financial leverage and its significance. Agenda: Introduction to debt to equity ratio, calculating the debt to equity ratio, impact on financial health, influence on shareholder returns, strategies for optimizing debt to equity ratio. Debt to equity ratio. The debt to equity ratio represents the relationship between total liabilities and shareholders' equity, highlighting financial leverage. Formula explanation. The formula for the debt to equity ratio is total debt divided by total equity, offering a simple calculation method. Financial leverage insights. This ratio provides insights into the level of financial leverage a company is using, indicating potential risk levels. Components: debt and equity. Understanding debt. Debt encompasses all borrowed funds, including loans and bonds that companies use to finance operations. Understanding equity. Equity represents the shareholders' investment in the company and signifies ownership interest in the firm. Importance of components. Understanding both debt and equity components is critical for conducting accurate financial ratio analysis. Importance in financial analysis. Debt to equity ratio. The debt to equity ratio measures a company's financial leverage and helps assess its risk profile. Understanding financial risk. Higher debt to equity ratio indicates greater financial risk, which can influence investor confidence and decisions. Impact on investment decisions. Investors use the debt to equity ratio to make informed decisions about potential investments and their associated risks. Steps to calculate. Gather together debt figures. The first step is to collect all the company's total debt figures from financial records. Determine total equity. Next, find the total equity from the company's balance sheet, which represents ownership capital. Apply the formula. Finally, use the formula total debt divided by total equity to calculate the debt to equity ratio. Example calculation. Understanding debt to equity ratio. The debt to equity ratio is a financial metric that compares a company's total debt to its total equity, indicating financial leverage. Calculation example. In this example, the company has debt of $500,000 and equity of $250,000, yielding a ratio of 2.0. Interpretation of ratio. A ratio of 2.0 indicates the company has $2 of debt for every dollar of equity, showing financial risk. Interpreting the results. Understanding debt to equity ratio. The debt to equity ratio helps assess a company's financial leverage and risk exposure. A higher ratio indicates greater reliance on debt financing. Implications of a high ratio. The debt to equity ratio above 1 signifies more debt than equity, which may suggest a higher financial risk for the company and potential instability. Benefits of a low ratio. A ratio below 1 indicates a more conservative financial strategy with less reliance on debt, promoting stability and lower risk. Indicators of financial leverage. Debt to equity ratio. The higher debt to equity ratio signifies more financial leverage, which can enhance profits but also raises risk. This is impact on the financial health. Financial leverage impact. Increased leverage can magnify returns but also heightens the potential for financial distress. Regular monitoring. It's crucial to regularly monitor financial leverage indicators to manage risks effectively. Risk assessment. Debt to equity ratio. The debt to equity ratio is a key metric used for assessing a company's financial risk by comparing its total liabilities to shareholder equity. Investment risks. A high debt to equity ratio may indicate higher investment risk, raising concerns about a company's financial stability during downturns. Economic downturns. Understanding the impact of economic downturns on companies is crucial for investors as it affects their ability to fulfill obligations. Impact on credit ratings, debt to equity ratio. The debt to equity ratio is a critical factor in determining a company's financial stability and creditworthiness. Credit ratings. Credit ratings are influenced by a company's financial ratios, particularly the debt to equity ratio, impacting borrowing ability. Borrowing costs. Higher debt to equity ratios typically lead to lower credit ratings, resulting in increased borrowing costs for companies. Influence on shareholder returns. Debt to equity ratio. Higher debt to equity ratio can enhance ROE by leveraging debt to amplify profits, but it also raises financial risk. Impact on return on equity. Increasing debt can lead to higher returns, but careful consideration of financial stability is crucial to avoid excessive risk. Balancing financial factors. It is essential to balance debt levels with equity to maintain a sustainable growth strategy and minimize risk. Earnings per share (EPS) impact on debt equity ratio. The debt to equity ratio influences earnings per share, reflecting a company's financial leverage and stability. Higher leverage effects. Higher leverage can lead to increased EPS, which may attract potential investors seeking growth opportunities. Associated risks. While higher EPS might look appealing, companies must be cautious of the risks associated with high debt levels. Dividend policy and payout, debt to equity ratio. The debt to equity ratio is a critical metric that can impact a company's financial stability and dividend policy. Impact on dividend policy. High levels of debt can limit a company's capacity to distribute dividends, impacting overall shareholder returns. Investor sentiment. The ability to pay dividends significantly influences investor sentiment and perceptions of company performance. High debt to equity ratio, stock price volatility. Companies with high debt to equity ratios often face increased stock price volatility due to financial leverage and market reactions. Impact of leverage. Leverage can amplify both gains and losses, impacting a company's financial stability and investor confidence. Low debt to equity ratio companies, financial stability. Companies with low debt to equity ratios often demonstrate higher financial stability, which attracts investors and increases confidence. Shareholder returns. Successful low leverage companies focus on effective shareholder return strategies, ensuring consistent returns over time. Leverage management. Proper management of leverage allows companies to minimize risks while maximizing opportunities for growth and investment. Balancing debt and equity. Importance of balance. Finding the right balance between debt and equity is crucial for financial stability in a company. Minimizing risk. A well-balanced debt to equity ratio helps minimize financial risks while ensuring company growth. Maximizing returns. Strategically balancing debt and equity can maximize returns for shareholders and improve overall profitability. Managing financial risk, debt to equity ratio importance. Maintaining a favorable debt to equity ratio is crucial for a company's financial health and stability. Risk assessment measures. Implementing risk assessment measures helps identify and mitigate potential financial pitfalls effectively. Long-term financial planning, debt to equity optimization. Long-term financial planning strategies help in optimizing the debt to equity ratio, ensuring a healthy capital structure. Future needs anticipation. Companies must anticipate future financial needs to make informed decisions regarding investments and financing. Capital structure alignment. Aligning capital structure with future business needs is crucial for financial stability and growth. Conclusion. Importance of debt to equity ratio. The debt to equity ratio is essential for assessing a company's financial health and its implications for shareholder returns. Optimizing financial leverage. Companies can optimize their leverage by employing effective strategies and learning from successful case studies. Managing financial risks. Managing risks is crucial while optimizing leverage to ensure stability and growth in shareholder value. Thank you.